The Federal Reserve's institutional independence represents far more than domestic economic policy autonomy. It serves as the cornerstone of global financial stability and the foundation upon which American monetary hegemony rests. When foreign central banks, sovereign wealth funds, and international corporations hold trillions of dollars in reserves, they do so based on confidence that American monetary policy operates according to economic fundamentals rather than political considerations that could compromise the currency's stability and purchasing power. The systematic political pressure being applied to Fed decision-making processes threatens this confidence in ways that could trigger fundamental shifts in global monetary arrangements that have favored American economic and strategic interests since the Bretton Woods system established dollar dominance in the post-war international order. The direct threats and public pressure campaigns directed at Federal Reserve Chair Jerome Powell represent unprecedented violations of the institutional boundaries that have insulated monetary policy from political interference since the Federal Reserve gained effective independence from Treasury Department control in the 1950s. When political leaders publicly demand specific interest rate decisions, threaten to remove Fed leadership for policy disagreements, or coordinate media campaigns designed to influence monetary policy announcements, they compromise the institutional credibility that enables central bank effectiveness while sending signals to international observers that American monetary policy may be subject to political manipulation rather than economic analysis. What makes this monetary politicization particularly dangerous is its timing, as global competitors have been systematically developing alternative monetary systems designed to reduce international dependence on dollar-denominated transactions and Federal Reserve policy decisions. China's digital yuan implementation, the BRICS payment system development, and the increasing use of bilateral currency arrangements for international trade all represent efforts to create monetary alternatives that could rapidly gain adoption if confidence in Federal Reserve independence becomes compromised. The intersection of domestic political pressure on Fed independence with international monetary competition creates optimal conditions for accelerated de-dollarization that could fundamentally alter global economic power relationships. The technical mechanisms through which political pressure compromises Federal Reserve effectiveness extend beyond direct threats into systematic campaigns that undermine public confidence in monetary expertise and institutional competence. When political narratives portray monetary policy decisions as partisan rather than technical, they create public skepticism about Federal Reserve analysis and decision-making processes that reduces the institution's ability to guide economic expectations and coordinate market responses effectively. Modern monetary policy operates largely through expectations management and forward guidance rather than direct intervention, meaning that political controversy around Fed decisions reduces their economic effectiveness while increasing market volatility and uncertainty. Intelligence community assessments indicate that foreign adversaries have been systematically monitoring American monetary policy debates for signs of institutional weakness that could be exploited through coordinated economic warfare campaigns designed to accelerate dollar decline and undermine American economic influence globally. Russian and Chinese economic warfare capabilities include sophisticated techniques for amplifying existing political divisions around monetary policy while implementing coordinated attacks on dollar stability through currency markets, commodity trading, and diplomatic pressure on allied nations to reduce dollar usage in international transactions. The politicization of Fed independence provides these adversaries with optimal conditions for implementing monetary warfare strategies that could not succeed against a unified and institutionally credible monetary authority. The international alliance implications of compromised Federal Reserve independence extend far beyond economic relationships into fundamental questions about American strategic reliability and institutional competence that allies depend upon for military and diplomatic coordination. When European allies hold significant dollar reserves or NATO operations require dollar-denominated funding, they do so based on confidence in American institutional stability that political interference with monetary policy directly undermines. The Bank of England, European Central Bank, and other allied central banks maintain coordination relationships with the Federal Reserve that assume institutional independence and technical competence rather than political calculation, and the erosion of these assumptions forces allied monetary authorities to develop alternative coordination mechanisms that reduce American influence over global monetary policy. The economic warfare dimensions become apparent when analyzing how monetary politicization creates vulnerabilities that sophisticated adversaries can exploit through coordinated attacks on dollar stability and American economic credibility. Foreign central banks holding massive dollar reserves monitor Federal Reserve policy debates for signs of political compromise that could indicate currency instability, and systematic political pressure provides rationale for diversifying away from dollar holdings toward alternatives that offer greater institutional predictability. The timing of these diversification decisions becomes critical during periods of heightened political pressure on Fed independence, as coordinated moves away from dollar reserves during politically sensitive periods could trigger currency crisis that amplifies existing political pressures while providing adversaries with increased leverage over American economic policy. Congressional oversight responsibilities regarding Federal Reserve independence create constitutional dilemmas when legislative pressure exceeds the boundaries of legitimate oversight and enters territory that compromises institutional autonomy essential for monetary effectiveness. While Congress maintains constitutional authority over monetary system architecture and Federal Reserve institutional design, direct pressure regarding specific policy decisions violates the independence framework that Congress itself established to insulate monetary policy from short-term political considerations. The challenge involves distinguishing between legitimate congressional oversight of institutional performance and illegitimate political pressure that compromises technical decision-making processes essential for monetary policy effectiveness. The precedent established by successful political pressure on Federal Reserve decision-making extends beyond immediate monetary policy into broader patterns of institutional capture that could affect other technically driven institutions essential for national security and economic stability. If political pressure successfully influences Fed decisions contrary to technical analysis and institutional judgment, similar pressure tactics could be applied to other independent agencies, including banking regulators, securities oversight bodies, and international economic coordination institutions that require insulation from political interference for effective operation. This precedent creates systematic vulnerabilities across the entire framework of technical institutions that enable complex modern economic systems to function effectively. Market participants worldwide monitor political pressure on Federal Reserve independence as a leading indicator of American institutional stability and democratic governance quality that affects investment decisions, currency holdings, and long-term economic planning that extends far beyond immediate monetary policy impacts. International corporations planning decade-long investments in American facilities, foreign governments negotiating long-term economic agreements, and global financial institutions managing multi-trillion-dollar portfolios all incorporate assessments of American institutional stability into their strategic planning. Political compromise of Federal Reserve independence signals institutional vulnerability that affects these long-term economic decisions while providing competitive advantages to nations offering greater institutional predictability and monetary policy credibility. The technological dimension of this monetary challenge intersects with digital currency development and alternative payment systems that could rapidly displace dollar dominance if American monetary credibility becomes sufficiently compromised through political interference. Central bank digital currencies being developed by China, Europe, and other major economies offer alternatives to dollar-denominated international transactions that could gain rapid adoption during periods of uncertainty about American monetary policy independence and institutional credibility. The technical infrastructure for alternative monetary systems already exists and requires only sufficient political and economic incentive for widespread adoption, meaning that compromise of Federal Reserve independence could trigger rapid shifts toward alternative monetary arrangements with permanent strategic consequences. The coordination challenge extends beyond domestic institutional protection into international monetary diplomacy that requires consistent and credible monetary policy frameworks for effective participation in global economic coordination mechanisms, including G7, G20, and IMF policy coordination efforts. When other major economies question American monetary policy independence and institutional credibility, they become less willing to coordinate policy responses to global economic challenges while becoming more interested in developing alternative coordination mechanisms that exclude American participation or reduce American influence over global monetary policy directions. As I conclude this analysis, I recognize that the politicization of Federal Reserve independence represents far more than domestic economic policy disagreement. It threatens the institutional foundation upon which American monetary hegemony and global economic influence depend for their continued effectiveness. The systematic erosion of institutional independence that insulates monetary policy from political pressure creates vulnerabilities that sophisticated adversaries are positioned to exploit while potentially triggering permanent shifts in global monetary arrangements toward alternatives that reduce American economic and strategic influence worldwide. The decisions made regarding Federal Reserve institutional protection over the next several years will determine whether American monetary hegemony continues as a foundation for global economic leadership or whether political pressures succeed in compromising institutional credibility sufficiently to accelerate the transition toward multipolar monetary systems that fundamentally alter the international economic order.